the title of this panel discussion is Global Sources of Institutional Capital. So we have a big topic. We have 45 minutes, 44 left to cover the globe. We are going to start kind of globally and then work our way back to U.S. markets and maybe with a few comments even on perspectives on the New York market. So we have a spectacular panel of some of the largest and most active institutional investors globally, who are, I'm eternally grateful for them to take the time. You can hear me, right? Is this not working? You can start talking. All right. This one on? Mm-hmm. Is this on? So in any event, I am going to start by asking each of our esteemed panelists to introduce themselves and their organization. So please, Roberta.
I'm very excited to be here.
Is that not working?
I hope that my mic, yeah, now it's working. And I wanted to, Roberta Waxman-Lentz. I am with the United Nations Joint Staff Pension Fund. And let me tell you a little bit about the United Nations Pension Fund. It is a joint staff pension fund because we invest on behalf of the beneficiaries not only of the United Nations, but also 22 sister organizations, ones you know, UNESCO, World Health Organization. And our goal every day when we come into the office is to be able to make sure that at the end of the day, the people who work at those institutions, the United Nations, are able to receive their pension. And one of the great parts of the job is to have this global perspective that we do have. We say that we have a mandate to look every place, but not necessarily invest every place, because again, we're looking at the bottom line. And we do invest across asset classes, so in equities, fixed income, private equity, and real estate. Our target for real estate is a 9% target. And we, as far as the real estate portfolio goes, being a pension fund, we are relatively conservative in that we're looking for those investments that are on the core side, the lower risk, lower return, and then all the way up to opportunistic. And we'll get into this later, I'm sure, but we do use real estate as a diversifier in our portfolio. I was told that we should also talk a little bit about the personal side. So previously, before I joined the United Nations Pension Fund, I was working at a real estate consultant. And we always said there that when we are learning all the different aspects of that there is to learn about real estate, we were drinking from the fire hose because there's such a wealth of information. There's data, there's the bottom-up perspective, there's the top-down perspective. And that learning experience was very exciting, and fortunately that consultant also had a very global perspective. And I'll just pass it on to Lisa to introduce herself.
I'm Elisa, is this on?
They'll turn it on.
Okay. I'm Elisa Mall with the Carnegie Corporation of New York, which is Andrew Carnegie's private foundation and the oldest private grant-making institution in the country. Our mission is the advancement and diffusion of education and knowledge. So our key areas of grant-making are education, international peace and security, democracy, immigration. We are a $3.5 billion endowment. Real assets comprises 15% of the portfolio, and that's divided between real estate, oil and gas, natural resources, sort of anything that you can touch and feel. Right now, our traditional real estate, or what you would categorize as traditional real estate, is just under 9%. And it's one of the oldest parts of our portfolio, so it's pretty mature. In contrast to Roberta, we use real estate as a diversifier, but we also use it as a driver of returns. So we are, I would say, less conservative. We look for niche, idiosyncratic opportunities because we're small. We're able to access things in a different way than some of my larger peers here. And we look for higher returning strategies and are willing to take on some risk to get those returns. On a personal note, I started my career as a real estate attorney, transactional attorney, and then I worked on the GP side. And at some point during my time there, I thought, oh, I think the other side looks kind of interesting. and I've been at Carnegie for 10 years now.
So I work for the Norwegian's sovereign wealth fund, the unlisted real estate arm. We call it NBREM, Norges Bank Real Estate Management. And it gets all of its inflows from all petroleum-related revenue in Norway, which has grown quite a lot over the last 2 decades. So the mission of the fund is to preserve and grow capital for future generations, so we have a very long-term investment horizon. The other aspect of the fund is that the government can draw from the returns every year to balance the budget up to a certain amount. So we're also focused on income. The role of real estate in the fund is relatively new. So we started in real estate in 2010 and only came to the US. I moved here, I started in 2011, and we did our first investment here in 2013. The role of real estate within the fund is a diversifier. So the goal within our unlisted real estate portfolio is not, diversification is not a goal in and of itself there, which allows us to have a very efficient and focused strategy. Right now, so coming into the market in 2013 into the US, we've grown that portfolio now to have $13.7 billion of equity exposure in the US market. And that represents our, I'll call it our 49% stake in around $22 billion of office and retail assets. That's in 4 markets, so it's very concentrated strategy, and $8 billion of logistics. So where we're trying to get to, we're only 2.6% now of a $1 trillion fund, trying to work our way toward 5 to 7% over time. We don't have time pressure, so we are pacing it out as we see appropriate, but that's what we're very focused on trying to do. On a personal note, I've been on the real estate principal investment side for almost 20 years. So my past life was all in closed-end funds with Whitehall and then a pan-European retail-focused fund, which also employed more leverage and had a little bit of a different time horizon. So I kind of had to reverse learn a lot of things when I moved over to the Norwegian Sovereign Wealth Fund. So it's a little bit of a different strategy in the types of assets that we target, given our time horizon and risk profile.
Okay. Is this on? Not yet. Start talking and he'll catch
Okay. My name is Gary Phillips. I'm responsible for all the equity investing in the real estate side in the Americas on behalf of Allianz Real Estate. We are the captive advisor for the group of Allianz companies worldwide. Allianz is a $2.4 trillion company. However, on the insurance side, which is really Allianz Real Estate's focus, we're at about a 700 billion euro portfolio. Of that right now, 60 billion is in real estate. So we are currently underweighted. Our German investors would like that to look closer to 100 billion. So we're in significant growth mode on a global scale. Real estate plays a very important role in our portfolio. As a large insurance company, we take a very long view. We have long-term liabilities that we're trying to match long-term assets with. So because of that, we have a large exposure to fixed income. So the role that real estate plays in our portfolio is not only diversification, but also yield enhancement on a global scale. On a personal level, I've been in the real estate business in New York for close to 20 years. Been at Allianz for 8 years, almost. And prior to that, I spent 8 years at Clarion with a very easy job of trying to make Dave look good.
You had remarkable training, I must say. And I think I neglected to introduce myself. I'm Dave Gilbert. I'm the CEO and CIO of Clarion Partners. So the world is a fascinating place, ever-changing, rapidly evolving. The task of the panelists, even if their focus may be U.S., is to be part of a global organization. A couple of quick facts maybe set the stage. And by the way, there's a great argument that capital flows can matter as much or more than fundamentals in influencing pricing. So transactions, volume, et cetera, is something we track and has great impact. So global transaction volume declined 5% year over year, roughly steady. The Americas strong 17% increase year over year, while Europe and Asia saw a slowdown. Some of the positives: U.S. up 13%, France 19%, Hong Kong up 65%. And South Korea, notwithstanding geopolitical tensions, up 62%. Negatives, Mexico, 40%, Japan, 24%, Australia, 14%, Canada, down 15%, and Brazil, maybe not unexpectedly, down 14%. But the top 30 global metros accounted for 55% of the volume. Well, the top 5 accounted for 20%. So that concentration in large, deep, liquid markets isn't a surprise. But so for some of the panelists, Roberta, how do you think about the world in terms of markets and how diversified you need to be? And globally, where's your focus now?
You know, the numbers that you've given and the trends are really a year-on-year trend that you're talking about. Just to take a step back before I answer how we look at things, it is important to look at the trends, obviously, longer term, and I think that all of us are actually long-term investors. And so if you look at the trends for US versus Europe versus Asia, while the U.S. is up year on year, if you go back to 2007, 2009, you saw a precipitous drop. As we all know, transaction volume dropped about 90%. And up through 2015, it has come up about 8 times. And then if you look at Europe, you have a similar trend, not quite as steep a drop off, and then come up back up since 2009 to 2015 by 6 times. And then for Asia, what's most interesting to me is that you see, again, a trend, the fall off, but only 50% drop for Asia. And then the trend there comes back up continuously from 2009 to the present. And there is not a drop off from 2015 to 2018. And the reason that I go back through all of that trend data and the longer term trend is that while we all know that real estate goes through cycles, this kind of cycling, a one year drop off or a 1 year increase, isn't really anything that I can hang my hat on when I'm looking in terms of investing for the United Nations Pension Fund. We're looking long term. We're looking to the paying out the beneficiaries in the long term, and we're looking at those trends. And so what I'd say is that whether they're for that 1 year change, that's not significant. For the longer term trend, what I think most people in this room would agree is that we are nearing the end of the cycle. Whatever that looks like, whatever the real time frame is for that, we don't know. But it does mean that we'll continue to invest globally. And then the other part of what it means for us is that we will look at certain property types more seriously or try to dig into them more in the knowing that we need to look for some kind of protection in what's coming in the next few years for where that next correction happens. Does anybody else have something to add about their perspective?
I would say that we have a very focused strategy. So our strategy is really looking at which markets have historically been key contributors to the global economy and which markets will continue to be. So really laser focused on about 10 to 15 markets. Right now we're active in 9. Also logistics is a global operating place. So I can speak to transaction volume, what we've seen. I mean, fortunately we entered in 2013 in the US. It would have been great to come in a few years earlier. But we did see enhanced transaction volume, including for ourselves in 2013 to 15. We had our largest transactions in 15 in the US with Hudson Square here and KTR. And since then, we have seen a slowdown. What we are noticing in bidder pools is that the who is showing up and how many people showing up, the depth of bidder pools is definitely different. So you might see transactions still hitting certain yields, but how many bidders are actually at that pricing has changed. And that it has been very impacted by, is it foreign capital, which foreign capital, what are their costs of capital, has hedging or tax implications changed how expensive US investments are for them. And that has been a very, very noticeable difference. I think there's a general sentiment that people might want to slow down at this point in the cycle. It's seen in our investment pace and for others as well. But I think we'll continue to invest through cycles. We believe in the long-term growth. the question really is, what is the difference geographically between what the risk-free rate is, where yields are, where do we see growth, and is that growth sustainable? And I think there's some concerns there that are valid for the medium term, maybe not for the next year or two.
Thank you, Karen. You touched on a whole lot of topics. One which has always fascinated me is global investors. Everywhere you go, you talk to global investors, and they love their home market. Typically, they have there's advantages tax-wise and currency. You don't have currency risk. Going offshore, every investor wants a premium to go to someone else's market, and you've got this basket of investors all comfortably at home with frictional costs that can be quite high to go offshore. So Gary, how is Allianz dealing with that?
Really, just as you said it, a massive part of our portfolio is located in major German cities and in Paris, and we're able to accept a way lower yield there than we do across the globe. Our expansion markets, though, however, because of our weighting towards those markets, are the U.S., Canada, and thoughtfully throughout Asia. But we are looking for a slight premium to be in those markets, and because of the frictional costs, the tax structuring that we require, particularly here in the U.S., and then you layer in, over the last couple of years, the spike in hedging costs, it's made it increasingly difficult to deploy capital at the risk profile that we want to do in the U.S. That being said, we've been pretty active, so I think we have a pretty good acquisition team.
Lisa, any thoughts on how you invest in the litany of risks and how you deal with those?
So we're a very lean team and a small organization. So we run a global portfolio, but when we think about where we can be most effective, we've made a deliberate decision that for our real estate portfolio, we are North America focused. We have a lot of emerging markets exposure and global equity exposure, but the difference in those strategies is that they're liquid, and so we can get in and out and be a little bit more tactical. Our real estate portfolio, as you all know, is very illiquid, and we have investments that date back to the mid-90s that we can't get rid of, which ties in a little bit to how we think about markets and capital flows. But we as a team think we can do the most effective job essentially in the US, where we don't have currency risk, we don't have political risk, our networks are stronger, we can really monitor what's going on. We did make some further flung investments about 10 years ago, and we didn't get paid for them. I mean, the risks were suboptimal to the US, and the drain, at the end of the day, we only invest through closed-end funds. And so at the end of the day, it's just a small group of people making decisions about how to best manage this capital and be stewards of the capital. And so when you think about that and you take a step back, we're just much more effective in the US.
Thank you. So I'm maybe get a little more specific, and maybe under the broad auspice of political risks and some of the changes. Brexit and London. London has still received, it just bats so far above its weight. It's this top destination within Europe and one of the most attractive foreign destinations for capital flows. 90% of the capital flows inbound to London were from offshore. Any perspectives on London, impact of Brexit, if at all?
Yep. Well, London is a very important market for us. One of our general themes globally is to invest in 24/7 cities, and London obviously is a 24/7 city. So we need to be there, English speaking, it's common law, and it operates in many ways like New York, at least in the trends right now, that it's becoming less dependent on the financial services sector and going more towards the TAMI sector. Brexit, we hope and we think that the politicians there are smart. It'll be a short-term volatility, but for us, it's a long-term market. We've been active there this year, not so much on the office side. We think that's perhaps a little expensive right now, but we put $500 million to work in the student housing sector, or they call it the student accommodation sector, and then we're also putting the finishing touches right now on a build-to-core logistics program in the UK. So it's an important market for us.
And I'd add that as we all know the Chinese saying of where there's crisis, there's opportunity. And certainly the UK is finding a way to prolong its crisis. But as things move forward and the Prime Minister works to figure out a road forward, there are opportunities. And it's interesting because talking with our managers who invest in London, in the UK in general, recently, what they've said is that Brexit, the vote came in 2016, so it's been 2 years. And with that, they've seen pricing start to loosen up, where they'd been pushing for certain prices to come down for them to be able to acquire something. They're seeing that to start to loosen up, and I was asking why would that be? And their answer is that it's 2 years. How long can you just keep saying it's too uncertain, I'm not selling, I'm not lowering my price? They need to move on. And that's what they're starting to see, even as you read all these headlines about the problems, the crisis, the issues going forward. So I agree that London is still a strong place. It's not going anywhere. Those buildings are still going to be there. They need to trade. And it is a very liquid market. And if you look long term, it will still be a worthwhile place to be invested.
Mm-hmm.
So the other headline, and this is much consistent with a longer term trend, and it makes sense, 35% of all global capital flows were in mega deals, meaning huge portfolios or even entity level, buying entire companies. There's natural reason for that is scale. And everyone here is a scale investor, but to very different degrees. So maybe a comment on your thoughts on participating in these large mega deals. Often you give up control in some of those, and there may be other tax reasons why having a partner in a very large deal is either helpful or essential. So Karen, any thoughts there?
Yeah, I mean, mega deals have been very good for us. We're very focused on scale and efficiency, and we really need to find things that move the needle. When we did KTR, there was a tremendous overlap with our target exposure in logistics. So in logistics, almost half of our portfolio is concentrated around LA and the New York, New Jersey area, which are 2 areas of focus. And so that's been great. Hudson Square has been great. There's been a lot of mega deals out there in the press, but not all of them, I found, had warranted. It's a lot of operational hassle and cost. Cost to our team. We also are a very lean and mean team to focus on those transactions. We've gone deep at looking at some of them, but on occasion we have found that you really have to have the right target portfolio that you'll end up with. And it's obviously, you also need to make sure you have the operational capabilities to operate. When you do these mega deals, they are often going to be cross-market or national. So doing it with the right partner and having the appropriate pricing, we haven't made it meet, gotten across the finish line on everything that we've looked at, but it is a trend and we are very focused on it. When we do a deal for $150 million, it's excellent and it can be very seamless in adding to our portfolio, but it's much more effective when we can buy a $6 billion logistics portfolio and end up with most of those assets long term.
There are very few people in the world that could finish that sentence. Well done. $6 billion to get you interested. Did you say you were a lean and mean team or just lean? I wasn't sure there.
I say lean and mean.
Okay,
Yeah.
good. Gary, any thoughts on mega?
Well, we've obviously most of our deals are fairly large in scale, given the amount of money that we need to put to work. We've taken a look at a lot of the public to privates and some of the entity level transactions that have either been executed or at least were attempted to be executed over the last 12 to 18 months. None were deemed a fit, either too pricey, not a structural fit, or just not the right partner. But we've definitely seen each of them, and we're not averse to doing it. One trend that we've seen, at least with the public to privates, why that's attractive to a lot of private equity players, is also a reason why we've been able to partner with a lot of public REITs over the last couple of years, and because of that discount to NAV, and we're able to provide them with a cheaper source of growth capital. So that's been a big trend for us over the last couple of years, and a way to play off of one of those mega trends.
So end of cycle is certainly something everyone's talking about. We were in a period until just recently of really remarkable synchronized growth among most of the major trading economies in Europe, Asia, and the US. Europe has started to slow a bit. Asia has started to slow. So you may see some differences in growth rates. If you knew for sure that there was a recession, normal economic cyclical correction, not a global financial crisis, let's hope that doesn't ever happen again, how would that influence your investing, say in the U.S.? Elisa, any thoughts?
Sure. If I knew for certain, I'd probably be in a different job. But setting that aside, I think we are positioning as if there's going to be a recession. And one of the things that looms large in our mind is the impact of the denominator effect, which did happen to us in the global financial crisis. Our equity portfolio declined so dramatically that suddenly we had this outsized real estate portfolio because the marks hadn't kept pace and we had all this unfunded. And that was a scary place to be because we have a 5% payout and we have to be mindful of that. So one of the things that we've done to position the portfolio in anticipation of a potential large correction or recession is we've moved a little bit out of some of the private asset classes. We've moved some into the absolute return portfolio, which is more liquid, somewhat more market neutral. And we've been thinking a lot about, particularly with respect to real estate, do we want to have some dry powder for some very opportunistic, distressed players that we can put money with, that can have the dry powder, that in the event that there is a recession, these are the people that play it really well, these are the people who know how to make money in those times, and that we could take advantage of it.
Yeah, I'd say that, it's hard to know. If we could ever have the gift of knowing where we could time the cycle. So we feel that we would have the conviction to buy, hopefully not too early into the downturn, but closer to the bottom. But it's very hard to catch a falling knife. The only thing you can know for certain is that you're buying an asset, and the next day it's going to be worth a lot less. And you're probably going to have to ride that out and answer a lot of questions for a little while. It was interesting from our fund history, which is not that long, but in 2007, we switched from 40% equity exposure versus fixed income to 60%. So mid-2007. So but it's very long-term macro deliberate decisions. And so we were determined to stick with the plan. Every new dollar of inflow that we got from the petroleum-related income, we would deploy into the equity market. And so we lost about almost a quarter value of the fund, which took a lot of stomach strength to manage through, almost $90 billion at that time. But we were also the largest buyers of equity through the recession. And that turned out, it looked very smart in hindsight, but that was an excellent test case for the fund about sticking with a long-term allocation. In the US, I think one of the challenges that we will have is that, as I said, it's hard to catch a falling knife. And here we need the aligned investment partners. And I don't care how many people say that they're going to be there with the dry powder alongside of you when things are getting really rough. Not all of them will be there. And so really thinking through who we should be aligning ourselves with should we find trouble in the market in the coming years has been a big focus of ours.
Yeah, and to that point, it's a lot of it depends on your objectives. If you're a long-term investor and if you truly are committed to the space, I kind of, this may sound perverse, but I kind of like the idea of a modest downturn. And usually, if you look at it throughout history, every major recession has been followed by a more minor one. And if that scares investors out of the market, at least the markets that we like to play in, which are historically very expensive to enter, that makes us happy. We'll back up the truck.
Okay, well, so this is where your training at Clarion differs. We are not hoping for a recession. Let's just be very clear. So Karen mentioned dry powder. That is also something very much in the press. It's $300 billion of dry powder, meaning capital that has been raised almost exclusively in closed-end fund structures that has yet to be invested. So there's a half-empty and half-full kind of perspective on that. A lot of excess liquidity can be a good thing. It means you're unlikely to see huge spikes in cost of capital because there's so much capital-seeking opportunity. And then on the other hand, it may mean a risk, meaning there's just too much capital to be deployed and the returns will fall foolishly because of an excess.
Roberta, where are you on that spectrum? 300 billion, good or bad?
I don't know that it's a good or bad. I think that right now that 300 billion, some of it will be invested before any kind of recession happens. And something that I'd add to what my three fellow panelists have said about what to do prior to setting yourself up for, positioning yourself for a coming recession is that we are looking at which property types. I mentioned this earlier, and we have been looking more seriously at multifamily. We've done some research about senior housing, student housing, and we do have some exposure in all of those already. But we're looking for the kinds of investments where we're more likely to be able to get that income. So when the devaluation happens because of the downturn, there will be still income coming in. Again, being a pension fund, where we need to look for that income to keep our boat afloat. And so I think that that's the other angle. I think that what each of us would be looking at is what kinds of properties are going to be, there's no such thing as recession resistant, but certainly able to hold us through during the time of a downturn.
Thank you. So let's maybe focus a little bit more on the U.S. So we don't have a whole lot more time left, and that could be of interest to the crowd. So the deal volume in the largest 6 metros is only at 5% year over year. And I know that's a short-term trend, but that is interesting. In the global search for yield, investors react differently. Some go to secondary markets, and we could spend the rest of the day defining what a secondary market is, but let's say something beyond the top 5 by market cap. Some go to alternative property sectors, and Roberta, you mentioned a little bit of that. That's self-storage, it could be parking, it could be manufactured housing, it could be single-family housing rental, which is a sort of a new class. It could be data centers, which is new, and some people even view as infrastructure. Elisa, any thoughts on your investing in search of yield in the U.S.?
So we've been, I would say, sort of burned in more tertiary markets, but secondary too. Some of the investments that are still in our portfolio from 1998, 2000 are assets that literally, like, we can't pay people to take for some reason. They're in markets that people don't want to be in. So as we've thought about, as we've refined our strategy over the years, we really do focus in more liquid markets. On a comment Karen made, we want to be in markets where the depth of the buyer pool, it may diminish, but that there's still going to be people that want to be in these 24/7 cities all the time. So we really do focus on major markets. However, we have a lot of exposure in sort of the alternative property types. We have senior housing, we have student housing, we have a lot of manufactured housing, which has been great for us. We have a little bit of data center. We've done a lot of work on cell towers, ground leases under them. So we are very willing and open to these sort of nichier property types. And I think given our size, this is an area where our size is an advantage because we can make a $20 million commitment. And those strategies tend to be very, very hard to scale, I think is the downside of a lot of them. Like manufactured housing just takes years to build a portfolio. But for us, we can make a $20 million commitment and it can be meaningful.
And everyone keeps calling these niche sectors, but everyone keeps talking about them.
Yeah.
And we don't view it as a much higher risk profile, particularly for student, which is the one that we're most active in. I mentioned that we're in London, but we're also, we made a large investment in the US in the student sector this year. And I would argue when you have a 10-year history of 100% occupancy, it's, as a long-term insurance company, that's way less risky than an office building in Midtown Manhattan, so, and much less volatile. So we view that space as a strategic growth initiative for us going forward. And Dave, I'm curious to hear your house view. You have a great research team. What's the house view on this subject from Clarion?
You're not allowed to ask me questions here. Well, listen, what people call alternatives, there's all sorts of ironies. The one that I find sort of the most striking is in prototypical private equity, risky things first get solved by illiquid, high-risk private equity. Think manufactured housing, right? Well, for some reason, we in the real estate industry have done this in a sort of backwards manner so that the alternatives largely assisted living, manufactured housing, self-storage, now even data centers, made it to the public markets in scale first.
And they're the highest performing. If you look at the 10-year track record, they've been the best performing REITs.
They have.
So to
With the
Gary's
low-
point, like the office REITs have really struggled and retail. And so in some ways, those have almost become the non-core property types.
It's fascinating that the public markets have taken risks at scale in a way that a lot of the private markets haven't. And you're right, over the last 10 years, virtually all of those high-risk alternative sectors on a total return basis have returned better returns than what we view as the big 4 or even 5 core, and with less volatility. There is one other part of it to adjust in price. When the public market started, the cap rates were quite high. So they've enjoyed this by institutionalizing a lot of those other asset classes, they've enjoyed a huge pickup. There is a role for all of it. One of the things that oddly constrains our investor base is the benchmark. And the benchmark still happens to be, for most of our clients, either Odyssey or NCREIF, which remains 5 property types. So there's an evolution that will undoubtedly occur, and that will be healthy, we think, so because there is clearly opportunity. We have 7 minutes left, and I was told to leave 10 minutes for questions, so we have 7 minutes. Questions from anyone, sir?
You had one question before about offshore investments as opposed to
Sorry, please repeat that.
All right, say one again. So earlier on in the conversation, you had indicated that there's a premium that you need to charge for an investment that is outside of your home country. So take apples to apples on an investment. What would that premium be? How many basis points?
It varies, and there's no exact science to it. It's more psychological, in my opinion, than anything. They just want to see a higher number on the piece of paper than what they're used to seeing in Munich or Frankfurt. But if you look back at the last several years, I would say it's anywhere from 25 to 50 bips on a total return basis.
Gary, you may want to comment because there is a science to tax and currency. So
Right.
how do you evaluate that additional load?
Well, so we're looking net in euro terms. So when we invest in Europe, obviously we're investing euros, and under the local tax regime, and there's partner loads if there is a partner involved. So we're looking at the absolute net return to our investors. And when we invest in the U.S., there's just a lot more load. So the total return at the property level is generally higher. You're buying at a higher going-in yield. There's better growth that you can underwrite with a straight face. And so your total return is just generally higher. The taxes are, if we structure it perfectly, is modest. It's the big culprit right now that gets us to a lower net return is just currency hedging, which right now is anywhere between 270 and 280 basis points off an unlevered 10-year IRR. So it's punitive.
What about the emerging markets? Do you invest there? What's
We
your premium
have.
for that?
So I don't know what our hurdle is for that, but it's been a big focus for us. So not so much South America. I would say the emerging markets that we're involved in are all in Asia. So India has been a big focus for us this year. We've been doing office and logistics in that market.
And it's 25 to 50 bips for that too?
That one would be a bit higher, I hope.
Any other questions? Sir.
So you mentioned Brexit earlier as this looming event of which there's still uncertainty around. Another thing the regulators have been quite vocal about, both sides of the pond, is the potential for LIBOR cessation at the end of 2021. We've started to see some liquidity in the alternative rates, whether it be SOFR, a few floating rate issuances, or SONIA on the other side of the pond. But there's still a ways to go in terms of building liquidity alternative rates. So I guess 2 questions. I think as investors in floating rate debt, how are you feeling about that looming risk? And do you think there is going to be appetite for floating rate debt that references the alternative rates going forward, at least more so than we've seen?
Gary, you're a big lender as well as a firm?
Yeah, but we don't do much floating rate debt. So this one is definitely not in our wheelhouse, at least on a local basis.
How about borrowing floating?
We don't borrow a whole lot. So most of the things that we do are unlevered. If we borrow, it's generally because of scale or because our partner wants to do it. When we borrow at a floating rate, it becomes a bit of an accounting headache from a German insurance company. So if we do, it's usually long-term fixed rate financing from 2 or 3 of the panelists before us, or 2 panelists before us. Any other thoughts?
It's not something where we are either, so.
Any other questions? It's a little hard to see here.
Gary mentioned net returns to investors. In that vein, do you see institutional capital moving more towards a direct investment model, perhaps like Norges has set up their own office, versus continuing with the closed-end private equity fund model with the management fees and the promotes, et cetera? Obviously, there's G&A in the Norges model, but long-term, where do you see the institutional capital model moving?
We're the same model as Norges. So we're local and we're investing on a direct basis. We don't really invest much in funds. And Dave, what are you seeing in terms of your capital raising? You talk to these investors all the time.
Yeah, well, our business, ironically, started as a separate account business. It is today 40% separate accounts, meaning we have a relationship with a typically very large, sophisticated investor, and it's a bespoke strategy. 60% are funds. Our fund business is growing much faster. Part of that is our open-end industrial fund has grown extremely rapidly, just given the challenges in achieving scale in that, and the benefit of having immediate scale in that business and the returns that have come from it. There's a place, typically smaller investors, and at least I'd love to get your perspective, have no option but to invest in scale in diversified funds, where you get to Norges and you need to write such enormous checks that there are a few funds, frankly, that could accommodate. Trouble with funds, also closed-end funds, the money comes back. So it's very hard to stay invested. But any thoughts, Elisa?
So I think the staff that you need, you mentioned G&A, is obviously very different if you're going to go direct. I think it varies by institution, but the smaller institutions, and by and large, most of the endowments and foundations, I think, will always invest through closed-end structures just because of resources. I do think, this interesting thing, everybody wants co-invest capital rights. Everybody negotiates it going in, and then what I've observed is when the co-investment opportunities actually come to the fore, nobody can actually move fast enough. So they want these, they want lower fees and direct access to investments, and then their shops just aren't set up the right way. So one thing that I think you are seeing a little bit more of is dedicated sidecar co-invest vehicles where the LPs, if you're invested in it, you don't have an opt-in, opt-out cherry picking mechanism. You're in every single co-investment, so it takes the decision out of the LP shop, so there is no direct underwriting. That's a trend I've seen that's a little bit of a tweener, but I'm not seeing a lot of people go direct.
The other thing that I'd add is right after the global financial crisis, there were a lot of our peers, pension funds, that were looking to get separate accounts. They wanted more control over their capital. They felt that some of their managers hadn't done them service them properly, that they had capital held when they thought that they should be getting it back. It should have been invested. There were all these conflicts that were going on in the conversation. So we did hear more pension funds that were looking for separate account kind of situations, and but that seemed to have tapered off. And so, I haven't, the jury's still out as to how well they did with those separate account investments as opposed to investing with the commingled funds. And I still hear more conversation, again, as Alyssa's saying, looking for that co-investment, but there's also still conversation among pension funds about getting a mix of that commingled investment and also some separate accounts and potentially direct.
I know we're out of time, but I'd say two things. One is, as you mentioned, scale. And for a fund, even a large fund, a typical ticket size, you could get up to around 50, 150, maybe $250 million. And if you're trying to deploy more than that, it gets a little bit hard if you are invested in many funds. But it also depends on your target exposure, right? So there's the core, there's the Odyssey funds, the core open-ended funds, but there's also niche strategies. And some niche strategies require such local skill set and presence that it's maybe more efficient to access through funds. So I'd say scale and what is the underlying target exposure that you're going for are two big factors that we think about.
We are indeed out of time. Please join me in thanking our panelists.